Many traders enter the financial markets believing that losses occur mainly because the market is unpredictable. Prices move up and down constantly, news events create sudden volatility, and no one can control the behavior of millions of participants trading at the same time. Because of this, it becomes easy for traders to assume that losing trades are simply the unavoidable result of randomness. When a position closes in loss, the explanation often sounds simple. The market moved unexpectedly. This belief creates the illusion that poor results are mostly external and outside the trader's control. While market uncertainty is real, relying on this explanation alone prevents traders from seeing a deeper and more important truth about how trading accounts actually decline. In reality, losses often follow recognizable behavioral patterns rather than pure randomness. A trader may repeat the same small mistakes again and again without fully noticing them. These mistakes can appear insignificant when viewed individually. For example, entering a trade slightly earlier than planned, moving a stop loss a little further away, increasing position size after a loss, or taking a trade that does not fully meet the strategy rules. None of these actions may seem severe in a single instance. However, when they occur repeatedly across dozens or hundreds of trades, their combined effect becomes powerful. The problem is rarely one catastrophic decision. Instead, it is the quiet repetition of minor behavioral errors that slowly shapes the long-term outcome of the account. This gradual process is what makes trading account decline so deceptive. Most accounts do not collapse overnight. Instead, the balance slowly erodes over weeks or months. A trader may experience occasional winning streaks that temporarily restore confidence, giving the impression that the strategy is still working. Yet beneath the surface, small mistakes continue accumulating. Each loss slightly reduces available capital, and each reduction increases the psychological pressure on the trader. As the account balance decreases, the emotional impact of every trade becomes stronger. The trader may begin to feel the need to recover losses quickly, which can lead to further impulsive decisions. What started as small, manageable errors gradually transforms into a cycle of stress and inconsistency. Another factor that contributes to this slow decline is the difficulty of recognizing the mistake while it is happening. When a trader reviews a single losing trade, the outcome may appear completely normal. Losses are an expected part of trading, even for profitable strategies. Because of this, it becomes easy to dismiss each loss as simply part of the game. The real problem only becomes visible when patterns are observed across many trades over time. Without careful record, keeping, or self-reflection, these patterns remain hidden. Traders may continue repeating the same behaviors without realizing that they are the true source of the problem. Short-term results can also hide the long-term damage. A trader might break their rules but still end up with a profitable trade. When this happens, the brain learns the wrong lesson. Instead of recognizing the rule violation as a risk, the trader may see it as a successful decision. This reinforces the behavior and makes it more likely to happen again. Over time, rule breaking slowly becomes normalized. What was originally an exception gradually turns into a habit. Eventually, when market conditions change or volatility increases, these habits begin to produce consistent losses. Emotions further complicate the situation. Trading naturally triggers strong psychological reactions such as fear, frustration, hope, and excitement. These emotions can make it difficult for traders to analyze their actions objectively. After a loss, the focus often shifts toward the market itself rather than the trader's decision-making process. Questions like, "Why did the market move against me?" replace more important questions such as, "Did I follow my plan?" or "Was this trade consistent with my strategy?" When attention remains focused on external factors, the internal behavioral patterns remain unexamined. Over time, this combination of repeated small mistakes, emotional reactions, and unnoticed habits slowly weakens the account. Confidence begins to decline as results become inconsistent. The trader may start doubting their strategy, even if the strategy itself was originally sound. In many cases, the real issue is not the method being used, but the way it is being executed. A strategy can only produce reliable results when it is applied with consistency and discipline. Without that consistency, even a strong system can lead to poor outcomes. The most important insight is that trading accounts rarely fail instantly. The dramatic stories of accounts being wiped out in a single day are actually less common than the slow, steady decline that many traders experience. This gradual deterioration is harder to detect because it does not feel like a crisis at first. Instead, it appears as a series of normal losses, minor adjustments, and small emotional reactions. Yet when these elements combine and repeat over time, they compound into significant damage. Understanding this reality is the first step toward improvement. Instead of viewing losses purely as the result of market behavior, traders must begin examining their own patterns of decision-making. Identifying recurring habits, especially the subtle ones, can reveal the hidden forces shaping trading performance. Once these patterns become visible, it becomes possible to correct them. In trading, long-term success often depends less on predicting the market and more on managing one's own behavior with clarity, structure, and consistency. One of the most important steps in improving trading performance is identifying the core mistake that quietly damages many trading accounts. While traders often focus on strategies, indicators, and market predictions, the real issue frequently lies in how decisions are made during the trading process. The market itself is not always the primary cause of poor results. Instead, the problem often emerges from the absence of structured discipline in risk management, emotional control, and adherence to predefined rules. These factors combine to create a pattern of behavior that gradually undermines long-term performance. A major component of this core mistake is ignoring structured risk management. Risk management is the foundation that protects a trading account from severe damage. It defines how much capital can be placed at risk in each trade and establishes clear limits that prevent losses from becoming uncontrollable. However, many traders either neglect this structure entirely or apply it inconsistently. They may enter trades without clearly defining how much they are willing to lose if the market moves against them. Without a predetermined stop, loss, or risk limit, the position becomes vulnerable to large and unpredictable losses. Another common issue involves inconsistent position sizing. Traders may increase position sizes after a few winning trades because confidence rises, or they may attempt to recover losses by placing larger trades than usual. This behavior disrupts the balance of the trading system. Even if a strategy is designed to perform well over time, inconsistent position sizing introduces unnecessary risk. When position sizes vary significantly from trade to trade, a single loss can erase the profits from several previous trades. In this way, the lack of consistent risk allocation slowly weakens the account's stability. Emotional decision-making further intensifies the problem. Trading naturally triggers powerful psychological responses because real money is involved. Fear and greed become two of the most influential emotions affecting a trader's behavior. Fear often causes traders to exit positions too early. When the market shows even a small movement against the trade, anxiety may push the trader to close the position prematurely. This prevents the strategy from reaching its full potential, especially if the trade would have eventually moved in the expected direction. Greed, on the other hand, encourages traders to take excessive risk. When a trade begins moving in their favor, traders may abandon their original profit targets and attempt to capture more than the strategy intended. In other cases, they may increase their position size in hopes of accelerating profits. These actions might occasionally produce larger gains, but they also expose the account to significantly higher risk. Over time, greed-driven decisions create an unstable trading pattern where the balance between risk and reward becomes distorted. Another aspect of the core mistake involves breaking trading rules. Most traders develop some form of trading plan or strategy that outlines when to enter the market, when to exit, and how much capital to risk. However, during live trading, these rules are often ignored or modified. Traders may enter positions that do not fully meet their predefined conditions, simply because the market appears to be moving quickly. This type of behavior is particularly common when traders fear missing out on a potential opportunity. Adjusting strategies during an active trade is another example of rule breaking. A trader might move a stop loss further away in order to avoid closing the trade at a loss. While this may temporarily delay the loss, it also increases the potential damage if the market continues moving against the position. Similarly, traders may modify their take profit levels, or change their strategy entirely based on short-term market fluctuations. These adjustments may feel logical in the moment, but they often undermine the consistency that a trading system requires to perform effectively. Impulsiveness also plays a major role in reinforcing the core mistake. Financial markets move rapidly, and this speed can encourage traders to act without proper analysis. Instead of waiting for clear signals that align with their strategy, impulsive traders may enter positions simply because the market appears active. Sudden price spikes or rapid volatility can create the illusion of opportunity, pushing traders to react quickly rather than think carefully. Entering trades during periods of intense volatility without a clear plan can significantly increase risk. In these situations, price movements may be driven more by market noise than by meaningful trends. Traders who react impulsively to these fluctuations often find themselves entering trades at unfavorable moments. When decisions are made in reaction to noise rather than structured signals, the probability of consistent success decreases dramatically. Over time, the repetition of these behaviors creates recognizable patterns in trading performance. The same types of mistakes occur repeatedly across many trades. A trader may repeatedly exit profitable trades too early, allow losing trades to grow too large, or enter positions that do not fully meet their strategy criteria. Each individual mistake might seem small and manageable, but the cumulative effect becomes significant. As these behaviors repeat, loss patterns begin to appear. The trading account may experience cycles of small gains followed by larger losses that erase previous progress. Gradually, overall performance deteriorates. The account balance may decline slowly, creating frustration and confusion for the trader who cannot easily identify the underlying cause. Understanding this core mistake is essential because it shifts the focus away from blaming the market and toward improving the decision-making process. Successful trading requires more than identifying good opportunities. It requires the discipline to manage risk consistently, control emotional reactions, follow structured rules, and resist impulsive actions. When these elements are strengthened, traders gain the ability to protect their capital and create a more stable foundation for long-term growth. In trading, mistakes rarely create immediate destruction. Instead, their real impact appears gradually as they accumulate over time. A single poor decision may seem insignificant, but when similar mistakes occur repeatedly, they begin to compound and shape the overall trajectory of a trading account. This process often starts with small losses that slowly transform into larger drawdowns, eventually creating both financial and psychological pressure for the trader. At the beginning, the losses may appear manageable. A trader might make a minor error, such as entering a trade slightly earlier than planned, increasing position size without proper risk control, or adjusting a stop-loss in an attempt to avoid a small loss. Individually, these decisions may not cause major damage. However, when such errors occur frequently, they begin to accumulate. Each small loss reduces the account balance slightly, and over time these reductions add up to a noticeable decline. As these small errors continue repeating, drawdowns begin to grow. A drawdown refers to the reduction of an account's value from its previous peak. While occasional drawdowns are a normal part of trading, repeated mistakes can make them deeper and more prolonged than necessary. What begins as a small decline in account balance can slowly expand into a significant setback. The larger the drawdown becomes, the more difficult recovery tends to be. Recovering from a drawdown requires proportionally larger gains. For example, losing a certain percentage of capital demands a greater percentage increase just to return to the original balance. As a result, traders who allow losses to accumulate gradually place themselves in a more challenging position. Instead of focusing on steady progress, they must now overcome the mathematical and psychological difficulty of rebuilding their capital. As losses increase, emotional pressure naturally begins to rise. Trading is already an activity that involves uncertainty, and repeated losses intensify that uncertainty. Traders may start feeling frustration, anxiety, or disappointment as they watch their account balance decline. These emotions can create significant psychological stress, especially when the trader begins questioning their ability to make correct decisions. This stress often influences future trades. When traders feel pressure to recover their losses, they may abandon their structured approach and begin reacting emotionally to market movements. Instead of calmly following their trading plan, they may make decisions based on fear or urgency. A trader who previously followed a disciplined process may suddenly begin acting impulsively, trying to compensate for earlier mistakes. In this way, emotional pressure not only results from losses, but also increases the likelihood of further errors. Another consequence of repeated mistakes is the gradual loss of strategic clarity. When trading results become inconsistent, traders often begin doubting the strategies they originally trusted. Even if the strategy itself is fundamentally sound, poor execution can create the impression that the system no longer works. As confidence declines, traders may begin making constant adjustments to their methods. These adjustments might include changing indicators, altering entry rules, modifying stop-loss levels, or experimenting with entirely new strategies. While adaptation can sometimes be beneficial, frequent changes usually create instability. Instead of developing expertise with a single structured approach, traders jump between different methods in search of immediate improvement. This constant shifting prevents them from building consistency and understanding how their strategy performs over time. As uncertainty grows, many traders also fall into the trap of overtrading. Overtrading occurs when a trader increases the number of trades in an attempt to recover losses quickly. The belief behind this behavior is simple: more trades may create more opportunities to make money. However, in practice, this approach often produces the opposite effect. When traders increase their trading frequency without proper analysis, the quality of their decisions tends to decline. Instead of waiting patiently for strong setups that match their strategy, they begin entering the market more frequently with weaker signals. Each additional trade introduces new risk, and when these trades are made impulsively, the probability of mistakes increases significantly. Overtrading also increases transaction costs. Every trade involves spreads, commissions, or other fees depending on the trading platform and market. When the number of trades rises dramatically, these costs begin to accumulate and reduce overall profitability. Even if some trades produce gains, the combined effect of frequent trading and higher costs can slowly drain the account. Over time, the combined impact of drawdowns, emotional pressure, strategic confusion, and overtrading leads to long-term damage to the trading account. As capital decreases, the trader's ability to take advantage of future opportunities becomes limited. With less capital available, position sizes must be smaller, and potential profits become reduced. This creates a cycle where it becomes increasingly difficult to grow the account back to its previous level. At the same time, confidence begins to deteriorate. Traders who once approached the market with curiosity and motivation may begin to feel discouraged or uncertain. Each new trade carries the memory of previous losses, which can make decision-making more stressful. Without confidence in their process, traders may hesitate during valid opportunities or exit trades prematurely due to fear. Ultimately, the sustainability of trading becomes threatened. Trading success depends not only on identifying profitable opportunities, but also on maintaining discipline, emotional control, and a structured approach to risk. When repeated mistakes are allowed to compound over time, they gradually weaken all of these essential elements. Understanding how mistakes compound is crucial for long-term improvement. Recognizing that small behavioral errors can grow into significant problems encourages traders to focus on consistency and discipline. By addressing these issues early and maintaining structured decision-making, traders can prevent minor mistakes from evolving into long-term account damage and build a more stable path towards sustainable trading performance. Once traders understand how repeated mistakes slowly damage a trading account, the next step is learning how to identify and correct those behaviors. Improvement in trading rarely comes from discovering a new indicator or a more complex strategy. In many cases, meaningful progress begins with recognizing personal patterns in decision-making and developing systems that support discipline and consistency. By carefully analyzing past behavior and implementing structured processes, traders can gradually replace damaging habits with more controlled and deliberate actions. The first step in this process is recognizing behavioral patterns. Many traders focus heavily on individual trades, analyzing whether a single position was profitable or not. However, the real insights often appear only when multiple trades are reviewed together. Looking back at a larger sample of trades allows traders to detect recurring behaviors that may not be obvious in isolation. For example, a trader might notice that losses frequently occur when entering trades during periods of sudden volatility or when deviating slightly from predefined entry conditions. Reviewing past trades also reveals moments when trading rules were ignored. These moments may involve moving a stop, loss further away, entering a trade without a complete setup, or exiting a position prematurely due to fear. At the time, such decisions may have felt reasonable or even necessary. However, when examined later with a clear perspective, they often appear as consistent behavioral patterns rather than isolated events. Another important element of recognizing patterns is understanding emotional triggers. Trading decisions are rarely purely logical. Emotions such as frustration after a loss, excitement during strong market movement, or anxiety about missing an opportunity can significantly influence behavior. By reflecting on past trades, traders can begin identifying which emotional states tend to lead to poor decisions. Recognizing these triggers makes it easier to develop strategies that reduce their impact in future trades. Once these patterns become visible, the next step is establishing clear and structured trading rules. A well-defined trading framework provides guidance during moments when emotions might otherwise take control. Clear rules help transform trading from a reactive activity into a disciplined process based on predefined conditions. One of the most important aspects of structured rules is defining precise entry criteria. Traders should know exactly what conditions must be present before a trade is placed. These conditions might include specific price patterns, technical signals, or broader market context. The key principle is clarity. When entry rules are clearly defined, it becomes easier to avoid trades that only partially meet the criteria. This reduces the likelihood of impulsive decisions driven by temporary market excitement. Risk management must also be clearly defined within the trading plan. Setting strict risk limits ensures that no single trade can cause excessive damage to the account. This includes determining how much capital can be risked on each trade and establishing a stop-loss level before entering the position. By deciding these factors in advance, traders remove the temptation to adjust risk emotionally once the trade is active. Planning exit strategies is equally important. Many traders focus heavily on entries but give less attention to how they will exit a trade. A structured plan should include both stop, loss levels, and profit targets, allowing traders to respond calmly to market movement. When exits are planned in advance, traders are less likely to make impulsive adjustments based on short-term fluctuations. Beyond defining rules, successful traders also develop structured decision processes that help them apply those rules consistently. One effective method is using a checklist before executing any trade. A checklist acts as a simple but powerful tool for ensuring that every trade aligns with the strategy. Before entering the market, the trader can confirm whether all required conditions are present, whether the risk level is appropriate, and whether the trade fits within the overall trading plan. This type of structured process reduces the influence of impulsive decision-making. Instead of reacting immediately to market movement, the trader pauses briefly to verify that the trade meets predefined standards. This pause can be extremely valuable, particularly during periods of high volatility when emotions tend to run strongest. Avoiding impulsive decisions during volatile market conditions is another critical part of building discipline. Rapid price movements can create a strong sense of urgency, encouraging traders to act quickly out of fear of missing opportunities. However, many of these opportunities are driven by short-term noise rather than meaningful signals. Maintaining a structured decision process helps traders remain patient and focus only on setups that truly align with their strategy. Emotional discipline is another essential component of correcting trading mistakes. Losses are an unavoidable part of trading, even for highly skilled professionals. Accepting this reality is important for maintaining psychological stability. When traders view losses as normal outcomes rather than personal failures, they are less likely to react emotionally after a losing trade. Avoiding emotional reactions after setbacks helps prevent a chain reaction of poor decisions. Many significant trading mistakes occur immediately after a loss, when traders attempt to recover quickly or prove that they were right. Maintaining emotional discipline allows traders to remain focused on the long-term process rather than short-term outcomes. Finally, improvement in trading requires continuous monitoring of progress. Developing better habits does not happen instantly. Instead, it occurs gradually as traders practice consistent behavior over time. Tracking performance metrics, reviewing trades regularly, and measuring how often rules are followed can provide valuable feedback. Monitoring progress also helps traders recognize improvements in discipline. Even if profitability takes time to improve, greater consistency in rule following is a strong sign that the trading process is becoming more stable. As structured habits strengthen, decision-making becomes clearer and more reliable. Over time, this process of recognition, structure, discipline, and monitoring allows traders to correct the core mistakes that previously caused account decline. By focusing on behavior rather than simply chasing better predictions, traders build a foundation for more sustainable and consistent performance in the financial markets. Preventing trading mistakes is not simply about avoiding losses. It is about building a structured approach that allows traders to remain consistent, disciplined, and focused over the long term. Many traders spend most of their time searching for better strategies, indicators, or market predictions. However, long-term success in trading often depends less on discovering new tools and more on developing habits that support stable decision-making. When traders build strong routines, protect their capital, and manage their emotions effectively, they greatly reduce the chances of repeating the mistakes that slowly damage trading accounts. One of the most effective ways to prevent future mistakes is by creating consistent trading habits. Trading should not be approached randomly or impulsively. Instead, it should follow a structured routine that prepares the trader both before and after each trade. Before entering the market, traders should review their strategy, analyze market conditions, and confirm that any potential trade aligns with their predefined criteria. After the trade is completed, reviewing the decision and documenting the outcome can help reinforce disciplined behavior. Repeating these routines regularly strengthens positive habits and gradually makes disciplined trading feel natural rather than forced. Another crucial principle in preventing long-term mistakes is prioritizing capital preservation. Many traders focus heavily on profit generation, but experienced traders often view protecting their capital as the primary objective. Without capital, there is no opportunity to participate in the market. By placing strong emphasis on risk control, traders ensure that individual losses remain manageable and that the overall account remains stable. This means avoiding excessive position sizes, maintaining clear stop-loss levels, and resisting the temptation to take unnecessary risks. Protecting capital allows traders to remain active in the market long enough for their strategy to demonstrate its potential over time. Managing emotional influence is also essential for long-term stability. Financial markets naturally create emotional reactions because real money and uncertainty are involved. Traders who are unaware of their emotional triggers may find themselves reacting impulsively during periods of volatility or after unexpected losses. Developing awareness of these emotional responses allows traders to recognize when their decisions are being influenced by fear, frustration, or excitement. With this awareness, it becomes easier to pause, reassess the situation, and return to a structured decision-making process. Maintaining calm responses during market fluctuations is another important skill. Markets often move quickly and unpredictably, creating situations that can feel urgent or stressful. Traders who rely on preparation and structured planning are better equipped to handle these moments. By preparing in advance and clearly defining their trading rules, they reduce the likelihood of making impulsive decisions under pressure. Structured preparation can significantly reduce stress and help traders maintain clarity even when the market becomes highly volatile. A strong long-term perspective further strengthens trading discipline. Many mistakes occur when traders focus too heavily on individual trades or short-term outcomes. A single losing trade can feel discouraging, while a single winning trade can create overconfidence. Evaluating performance over extended periods helps traders maintain a balanced perspective. Instead of reacting emotionally to each trade, they begin focusing on the consistency of their overall process. This mindset encourages steady improvement rather than constant reaction to short-term results. In the end, the most damaging trading mistakes are often behavioral rather than technical. Repeated small errors, when left uncorrected, can gradually lead to significant long-term losses. The solution is not simply finding a better indicator or a more complex strategy. The real protection comes from discipline, structured decision-making, and consistent risk management. Many traders spend years searching for the perfect system, yet overlook the importance of controlling their own behavior. The truth is that trading accounts rarely fail because of one dramatic event. More often, they decline slowly as small mistakes are repeated again and again. By building disciplined habits, protecting capital, and maintaining a long-term perspective, traders can break this cycle and create a stronger foundation for sustainable success in the markets.